Hello everyone, and welcome to this presentation of the 2 trading techniques I use every day. Welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. And first and foremost, for those people who are unaware of my company and my website, Specialist Trading is an educational website. I take all of the information, as you see, the insights, the wisdom, and the trading strategies that I've accumulated throughout my trading career, and teach and mentor all of my students and educate them so that ultimately they can empower themselves with all of this information and you won't have to have an extended learning curve. Just to give you a little bit of background about myself, I have been trading for a total of 37 years. I started out on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jen Red. So that's where you get the name Specialist Trading. I traded through the crash of 1987 and through the great bull market that followed afterwards. I left the floor in the mid-90s to manage money and to also pursue my own trading account. I've been the director of education for a number of websites, and 6 years ago I started Specialist Trading, where all I do is teach and mentor students and members all of my personal techniques and trading styles and trading methods. So everything that I've accumulated I teach on to my members so that hopefully they'll be able to empower themselves and be able to trust their own instincts and trade on their own. Now, we have a great presentation today because I'm going to share a lot of great information with you. But before we begin, as always, we are required to show you our disclaimer. So I ask that you please take a moment to view it. I'm going to show you a lot of performance results using these 2 techniques. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and as you're doing that, for those people who are new to my presentations, you'll know that I love to take questions from the audience, but I like to take them at the very end of the class. So please wait. If you have any questions, I know a lot of presenters like to take questions while the webinar is unfolding. I'm a little bit more old school. I like to wait like as if we're in a classroom and just wait to the question and answer portion. So we'll reserve the last 10 or so minutes for any questions that you may have. Also, I'd like to invite each and every one of you to follow us on Twitter. That's our handle right there, at SPCLSTTRADG. We post a lot of great free information, a lot of trading wisdom, as well as the signals that we are currently in. In fact, a little less than 2 weeks ago, I posted a signal that all of our members should have seen that are members of our courses. Actually, we had 3 signals to go along the markets, the Dow, the ETFs, as well as the S&P, and they were posted on Twitter, and you can all see what's happened the last couple of weeks with the markets. We've gone straight up. So this was a really great signal that all our members were privy to and that we posted also on Twitter as well. Okay, so remember, as I stated in the beginning, we are first and foremost an educational company. Why are we educational? Because I feel that that's the only thing that's really going to sustain you through your trading careers, okay? And I know this firsthand because when I first started trading on the floor, I couldn't make a dime. In fact, the first 2 years of my career, I really had a very difficult time trying to make ends meet. So my mentors taught me certain things that were able and ultimately able to sustain my career. That's why I've been able to trade 37 years. So this is what I share with all of my students in the courses, and this is what I'll be sharing with you today, what I learned from trading on the floor of the exchange. So my mentors taught me that first and foremost, trading should be 3 things. It should be non-subjective. That means if 2 traders look at the same market or the same scenario, they should come up with the same picture as to what you should be doing. In other words, you shouldn't have 2 traders looking at the same market and say, well, I think you should be going long, and the other one says, no, I think you should be going short. It's too subjective, meaning that everyone has a different idea about what should be taking place. So it should be non-subjective. Once you learn the techniques, you should all be seeing the same thing. Secondly, trading should be consistent. And really this flies in the face of a lot of educators. They're always looking for that home run, looking for that big score and that big, huge gain and how well we did. And that will happen from time to time at Specialist Trading. But what we're really looking for is consistency. And that's more of a hitting singles rather than hitting home run approach. So we're looking for a 2-step forward, 1 step back. We know we will have small minor losses from time to time. It's inevitable. But we're looking for that consistency. Our goal is not to hit this humongous home run or to have thousands of % gains each and every month or year. We're just looking for consistency because that's what's going to sustain us so that we can be trading 10, 20, 30 years down the road. And also they said Your trading should be as simple as possible. If you look at traders that have been trading for a relatively short amount of time, anywhere from 3 to 5 or 8 years, most of their trading plans are extremely complicated. Very convoluted logic, a lot of rules, a lot of neural networks, things that are very difficult to follow. They work great in times such as when everything is perfectly, the environment fits exactly what the system should be. But many times they're very difficult and very hard to put together and to actually trade in real time. So what we're looking for is what most of the traders who've been trading 30 or 40 years have their trading plans based off of, and that's simplicity. Most of our methods and strategies at Specialist Trading have no more than 5 or 6 rules. They're extremely simple, and the same rules that our hedge fund traders use in countries across the world are the same rules that someone trading for 2 weeks is following. So there's no difference in how long you've been trading or your amount of experience. The rules are extremely simple at Specialist Trading. But I think the most important thing that my mentors taught me and that they passed on to me was the fourth example here, and that's trading should make you a part of the process. It's my opinion that this is the reason why over 80% of most traders lose. Why? It's because you take yourself out of the game. You're relying too much on an outside source to either tell you what to do or tell you how to do it without you being a part of the process. In other words, too many traders are relying too much on trading rooms telling them what to do, systems telling them when to buy or sell. That's all well and good. It should be taken with a grain of salt, though. In other words, that should be maybe 20 or 25% of your decision process. The other 70 or 80% of your decisions should be based solely on what you have learned in your education. So this is what we do as Specialist Trading. We give you all the education that I've accumulated, but ultimately we want you, once you've understood it and mentored with me, then we want you to leave, and we want you to really make your own decisions. There's no reason to stick around and to feel that we have to tell you when to buy or when to sell. You should know that already. So we want to make you a part of the process. That's why we're all about educating you so that ultimately you can empower your own trading, okay? All right, so that's just a little bit about what our philosophy is at Specialist Trading. Now, how do we put that all together? Once again, for the people that may have been coming in late, if you have any questions, kindly wait till the end of the presentation to ask. I'll reserve the last 10 or 15 minutes for any questions. This won't be a real long one. And I'll just answer the first question that's most commonly asked, and that is this being recorded? Yes, it is. So if you have to leave early, or if you have, there's no way you can stay for the entire webinar, don't worry. You'll see the phone number and the email address in your chat box to the right. You can request a link to this, and we'll send you a link to this recording. Okay, so that's the most popular question we get anyway, is this being recorded? Okay, so now that we know the philosophy of Specialist Trading, we know what we're really looking for, sound education so that you can empower yourself, not so that you can have someone blindly tell you what signals to take. We want you to be a part of that process. Let's see how this all works out. Now we're going to talk about the first of these two techniques I use, which is more of a money management technique, and this is involved in one of our money management courses. This is secret number 3 in a total of 7 secrets of money management. And what it concerns itself with is position sizing, because too many traders, in my opinion, are losing or not making enough because of their position sizing. So here's what secret number 3 is. Never, ever use discretion when deciding your position size. Okay? How many times have you woken up and said, boy, I really have a good feeling about the market or this particular stock or what this currency pair is going to do, and you know what, I'm going to bet the farm today. I feel confident. I had like 2 or 3 great trades. I'm gonna bet the max. Or let's say you've made a lot and you've done really well, but you're frightened because you think your streak's going to end. So you said, you know what, I'm going to pull in a little bit here. I've made a ton of money. Instead of trading max, I'm going to trade the least bit because I don't think I'm going to, my streak's got to end pretty soon. This is all what we mean by discretion. We don't mean an insight into the market. We mean more of wishing and hoping type of discretion. So where does this bring us to? Well, let's look at this example. And also, I'm going to start off by showing you a lot of older examples that are a year or 2 old, but mainly I'm just showing you these charts for educational purposes. At the end of this presentation, I'll show you examples using all the techniques I'll be sharing with you today that happened as early as today. Okay, so let's say you see this example here in the E-mini, you're trading this, and you want to go short. It meets all your requirements. Say, your strategy or system tells you to go short. So you enter at this point, and you have a nice trade, okay? You make a good 3 or 4 points real quickly on this short-term chart. So you're happy, but the point is, how many contracts should you have traded? Now, this was a winner, but what if it was a loser? Should you have traded 1, 2, or 3 contracts? How do we know how many or how little to be trading? And this can work with stocks, it can work with currency pairs, it doesn't matter what market we're trading. All right, so here's the first technique. It's the RPS method. This is something I learned on the floor. It may seem a little calculated, and it may seem a little wordy because it's a mathematical formula, but trust me, after a little practice, you'll know exactly how to do this in a matter of seconds. And this will be done prior to each and every trade. It's a simple mathematical formula, as you see here, that automatically decides how many shares or lots to trade. Okay, it takes the guesswork out. So let's concentrate on the E-mini. Let's see if we were trading the E-mini S&P, how would we use this formula? Well, remember, you may want to write this down, but you can request a link at the end of this presentation if you want to review this over at your own time, at your own leisure, so you don't have to worry about writing this all down. But these are the rules here for the position sizing formula, the RPS. First of all, you want to determine the 2% risk amount of your capital. So let's say you have, just to make things easier, let's say you have a $100,000 account. Don't worry, I know the majority of you don't, but let's just say you have a $100,000 account just to make things very easy for me mathematically. All right, so we're only going to risk on each trade 2% of that, which comes out to $2,000. Okay, now that's the benchmark. You can risk less than that if you'd like. You can risk 1.5%, 1%, even 0.5%. But we want you to stay at the standard 2%, okay? We don't want you really to go over that. If you have to feel that you have to risk more of your account, I would say no more than 3% max. But you should never risk more than that. And so if however big your nest egg is, you're only per each trade going to risk 2% benchmark of that capital, okay? Once you decide and figure out what that is, then you're going to decide your stop placement. Doesn't matter if you're going long or going short. You have to know where your stop's going to be prior to the trade. All right? You can't go into a trade without knowing where you're going to get out if you're wrong. You have to know that in advance. So we have to know what our stop's going to be. And then rule number 3 is, if we're stopped out, let's say it immediately goes against us, what would be the total dollar amount lost per contract? We're trading the E-mini here. So what would be the total dollar amount? In other words, we're not concerned with points, how many points we lost, or how many pips. We're concerned with the dollar loss, all right? So here's how the formula works. Rule number 4. We're going to divide our 2% dollar risk, whatever 2% is of our capital, by the total stopped out dollar loss amount, okay? Whatever points we lost transferred over into dollars. And once we divide these two, we're going to round off to the nearest number, and that gives us our proper position size. As I said, I know this seems a little wordy. Trust me, I've been doing this for over 30 years. You can do it in a matter of seconds once you get some practice. And let's cut this down to the actual formula here. This is the RPS formula. R equals the 2% risk amount of our capital. So remember, if we have $100,000, 2% will equal $2,000. P equals the point dollar loss if we're stopped out. So in other words, how many points did we lose? Transfer that over into dollars, okay? And we simply divide R by P, and that gives us S, or the size or number of contracts to trade. And that's it. So if we want to take a hypothetical, real simple example here, let's say we have a $100,000 account. R equals 2% of that $100,000 account, so R equals 2,000, as we see right here, okay? P equals the point dollar loss if we're stopped out. So we need to know where our stop would be prior to entering into the trade. So this particular example, we would lose 4 points, okay? Now what does that transfer over into dollars? Well, 4 points transfers over into $200 on the E-mini. So P equals 200. So you divide R by P, you divide 2,000 by 200, and this gives you S, or the size, which would equal 10. So with a $100,000 trading account, risking 4 points or $200, you can trade 10 lots or 10 contracts. All right, let's bring it down to earth a little bit. Let's say we have a $50,000 trading account, okay? Well, our risks now is going to be different because 2% of 50,000 now is 1,000. So R equals 1,000. P, we changed the stop placement now, so P is 3 points. Now 3 points, if we lost right off the bat, we lost 3 points, that would transfer over into $150. We would lose per contract. So R divided by P equals S. 1,000 divided by 150 equals 7. So as you can see here, we have a smaller account, we have a different stop placement, and now we automatically decide how many contracts we have. You see how the guesswork is automatically taken out. You're not coming into the trade saying, boy, this one really feels good. I just know this one's going to work. I'm going to trade 20 contracts. Or you're not coming into the trade saying, boy, I'm not really sure. I know some news is supposed to come out, and I'm a little scared, and this guy in the chat room doesn't think that this is going to work out, so maybe I'll only trade one contract. See, that's all discretionary. That's all coming from doubt, or all just coming from subjective thinking. We don't ever want that to appear anywhere when we're trying to decide our position size. All right, so let's look at a hypothetical $15,000 account now with that same example we originally showed you. We now have to figure out what R is. R is 2% of 15,000, so 2% is 300. So we know that as long as our account is at 15,000, each trade can risk, or R, $300. Okay? So we see here that this is where we wanted to enter, and where's our stop? Well, our stop would be right here. So we have to figure, if we're stopped out, how many points would that first come out to? Well, that would come out to 3 points. All right, but what does that transfer over 3 points into dollar amount if we're trading just one lot? Well, one lot, if we lost trading one contract and we lost 3 points, that comes out to $150. So R equals 300, P equals 150, so we divide R by P, and that gives us 2, or 2 contracts. So we could be short 2 contracts with these parameters, and we could have had a nice trade with 2 contracts here. What if you change your stop? Okay, well, let's try it. Same scenario with a different stop. We have the same hypothetical $15,000 account, so R is going to be the same. 2% of 15,000 equals 300, so R is 300. But now we're changing our stop to here. We're going to be a little bit more aggressive. We're going to, tighten up where the stop is on this particular scenario. So we're using this stop placement. So how many points would we lose if we immediately got stopped out? We would lose 2 points. Okay, so in the E-mini, 2 points per contract comes out to $100. So P equals 100. So now we just simply divide R by P, and this gives us 3, or 3 contracts. So in this scenario, with this account size, with this stop placement, we could now trade 3 contracts. You see how it's automatically deciding for us? We've taken all our subjectivity out of the game. What if you only use 1% of your account? Remember, 2 is the benchmark. We really don't want you going over 2%. But you can go lower than 2. You can use 1 3/4. You can use half of 1%. Let's say we use 1% of that same hypothetical $15,000 account. Well, this means that R is going to be different now, because 1% of 15,000 is $150. So this means that's all we can play with. We can only risk $150 on any particular trade as long as our account is at 15,000. All right, so we want to enter at the same place. We're going to place our stop. Well, let's move our stop to midway. Let's say our stop is above this pivot right here. Okay, if we got stopped out, how many points would we lose? We'd lose 2.5 points, okay, from here to here. So what does 2.5 points transfer over onto a dollar amount? That comes out to $125 per lot. So R equals 1%, or $150. P equals $125. So all we did was we divide R by P, and this gives us S, which is 1 contract. So in this particular scenario, risking 1% of the same account size with a different stop, we could only trade 1 contract. Either way, you had a winning trade, but remember, it's not so much the winning trades we're concerned with as well. We also have to give equal amount of time to losing trades. So this is where this method really comes in handy, because at times when we are really doing well, it will increase our contract share or lot size. And when we're doing not so well and our account size is diminishing, it will decrease it, but it will do it automatically for us. In other words, we won't make the decision based off of ego or based off of fear. We'll make the decision based off of a mathematical formula. So if we want to, just conclude with what the first technique is that I use in all my trading, secret number 3 states we never ever use discretion when deciding our position size, okay? That's one thing you really have to take control of. Think about the trading you do, whether you are a position trader and you hold for a matter of months or even years, or whether you're a scalper and you hold for a matter of minutes. How do you decide how many shares or lots to trade? Is it just something that spur of the moment? Is it just something where you feel lucky, or are you frightened? You should never base any type of trading decision based off of those discretionary points. All right, so that was technique number 1. Now, I know a lot of you are saying, well, Steve, I'm new to trading. This is all great, but I don't have a strategy that I can trade with. Well, I'm going to give you the majority of the rules to one of our most consistent strategies. It's strategy number 4. Okay, so strategy number 4 has a total of 6 rules. I'm going to share with you the basic foundation of them today. I'm going to give you 4 of those rules. Okay, so we're going to share with you exactly what these highlights are to strategy number 4. Strategy number 4 is based on concepts number 1 and 2 of specialist trading. And just to share with you what they are, concept number 1 is we always trade in sync with the trend. Our proprietary tools tell us what the trend is. And concept number 2 is we only trade pullbacks or consolidation moves within the trend. Okay, so we will never, ever try to pick tops and bottoms of specialist trading. Trust me, I know that firsthand, because remember at the very beginning of this presentation I told you where I couldn't make a dime on the floor? It was because I was trying to pick tops and bottoms. And so ultimately that's a recipe for disaster. We want to trade with the market. We want to be in sync with the trend. So concept number 1 is always trade in sync with the trend. Concept number 2 is trade only pullbacks or consolidation within that particular trend. Okay, strategy number 4 is designed to trade quick momentum moves. So most of the time you are in this trade for no more than 1 to 5 bars. That could be a 5-minute bar, it could be a weekly bar, depending on what time frame you like. But once you become a member of our courses, we show you ways to extend that if you like. Because a lot of people will say, boy, Steve, I traded this is great, but I feel I'm leaving the table way too soon and leaving a lot of money on the table because it just kept going higher and higher. Well, we teach you how to stay in the trade much longer if you like. So don't worry. You can take the quick momentum move if you like, or you can use the advanced techniques to stay in the trade longer. Now, the intensity level of this strategy from 1 to 3, with 1 being the most intense and 3 being the least intense, is a 2. So in other words, a 1 intensity strategy would be something that you have to be in front of your computer at all times. You have to watch each and every tick, and that's fine. A lot of people like to trade that way. A 3 would be the type of strategy where you just simply enter an order and you walk away. Strategy number 2 falls right in the middle. It's very moderate, very simple to use. Its main indicator is the buy-sell line, which I'll go into detail, and I'll share that with you as well in just a few moments. Remember, strategy number 4, the beauty of this is that it works in any time frame, in any direction, and in any market. So the beauty of this course is that once you become a member of Strategy 4, if you trade multiple markets or multiple time frames, you'll see how well this works in all of them. And I'll show you a lot of examples today. There are only 6 rules to this strategy, but I'm sharing 4 of them with you. I'm sorry, I can't divulge the last 2 because that would be fair to a lot of the people that have already purchased this strategy for thousands of dollars. It wouldn't be fair. But I'm going to show you a way in which you can find out the final 2 at the end of this presentation. Remember, our edge at specialist trading is consistency. We're not looking to hit home runs with strategy number 4, even though that will happen from time to time. What we're really trying to do is have a 2-step forward, 1-step back approach. So I'm not going to sit here and tell you that every strategy number 4 trade works. Sometimes there are losers. But we have this consistency to this trading so that we can ultimately have this nice upward slope in our P&L statements. Okay, so let's talk about the indicators. Well, we said we're only going to use 1, and that's the buy-sell line. The buy-sell line is simply another word for the 50-period simple moving average. That's it. So there's nothing you have to plot. There's nothing, no advanced indicators or something you have to construe or something you have to put together, neural networks. No, we're only looking at the 50-period simple moving average and a couple of pattern recognition setups. That's it. We're not overcomplicating. Remember, I told you, if you look at traders who have been trading, 3-5 years, Their methods are extremely, extremely complicated. Tons of indicators, tons of things they're following, tons of reliance that you have to watch in order to have a valid setup. We just follow the 50-period simple moving average and a few rules on top of that, and that's it. And you'll see how consistent this strategy is. Let's go over the rules now. And remember, once again, don't worry. These are only 4 of the 6 rules, but don't worry if you can't copy these all down. This is recorded. You can request a link to this recording. Remember, this works on all time frames, all markets, and all directions. So don't worry about, well, Steve, I only trade monthly currency bars. Fine. You'll get signals on those as well. Or Steve, I only trade stocks in an uptrend. That's fine. You'll see a lot of buy signals. Okay. In fact, I spoke a little while ago where I said we had a great signal we posted on Twitter about the diamonds that we had a real buy signal in the market about 2 or 3 weeks ago. Well, one of those signals was a strategy 4. So it works on ETFs as well. Okay. All right. Here are the rules for going long. You just simply reverse these if you want to take a short setup. First of all, if we're buying, price must be above the 50-period simple moving average. Now, you know, a perfect scenario would be that price, all of the bars were above, but it's okay if you enter above the 50, and I'll go into that detail when I show you some examples. Rule number 2 is look to buy when a price bar closes in the top 25% of its range. Okay, so we want to find a bar that closes in the top 25% of its range. That's called the setup bar. If you're not familiar with 25% of the ranges, just look at any bar. It doesn't matter if it's, people get confused and say, well, Steve, can that be a candlestick bar? Or can that, it doesn't matter. In other words, you take the high of that bar and then take the low of that bar. Let's say it's 4 points from top to bottom, and you divide it by 4 separate equal points. So each quarter will be a point. And you just want to make sure that the price closes in that top 25%. That's it. Okay? If you find a bar that closes in the top 25%, you're going to enter to buy when price trades 1 tick above this bar's high. But here's the one main rule with this particular method. If the price bar does not trade 1 tick above the setup bar's high on the next bar, then we negate the trade. We're not taking the trade because we're looking for momentum. And to have a confirmation that momentum is going to continue in our direction, we want to see price trade 1 tick above the previous bar. So if it doesn't trade, most likely momentum has not continued, so we're not going to be involved in it. And so let's say we do get involved in the trade, we do purchase, let's say it does trade above, well, we're going to place our protective stop below the lowest low of the pullback. I'm going to show you some examples of this. So this may seem a little confusing right now. I'm going to show you a lot of charts, so it'll be really simple. Just remember, if you want to go short, you would just simply reverse these rules. All right, let's take it step by step. Remember, if you have any questions, wait till the next, probably in the next 5 or 10 minutes when we conclude this presentation, and then ask me questions then, okay? All right, step number 1, price must be above the 50-period simple moving average. All right, so we see here an older example, once again for educational purposes, of the E-mini here is above the 50. So this means we're only looking to go long. We're not even going to consider going short. So don't try to pick tops and bottoms. We're only going with the flow, and the flow is telling us right now that we're going higher most likely, so look for buy setups. So we are above the 50, so this is rule number 1. This means we're looking for a buy setup. We're not even going to consider shorting anything if price is above the 50. Step number 2, look to buy when a price bar closes in the top 25% of its range. This is called the setup bar. It doesn't, in other words, we're setting up for a trade. We still haven't entered the trade yet. We are setting up for a particular trade to be initiated. So we have the same scenario, and we see here that we close in the top 25%. So if you take the bar from top to bottom and you simply divide it by 4 equal measures, we want to make sure that price closed in the top quarter, okay? Now it doesn't matter if this is a candlestick bar, you just take the high of the wick and the low of the wick and divide by 4, whatever that range is, and we want to close in the top quarter, all right? So that's a setup bar. Step number 3, we're going to enter to buy when price trades 1 tick above this setup bar that we just located. So it has to trade above. Here's the one caveat though. It has to trade above on the very next bar. If it doesn't, then we negate it. We totally wipe the slate clean and go on and look for the next setup. So as you can see here, this is the setup bar. We have to trade above it, but on the very next bar. So let's see what happened. Well, we did. We traded on the very next bar, so we enter into the trade. Okay? Now, had we opened unchanged and then gone lower, we wouldn't consider this a valid setup anymore. But because we traded above on the very next bar, it's telling us, it's confirming that momentum most likely is heading in our direction, so we want to jump on board. Step number 4, we're going to place our protective stop below the lowest low of the pullback. So we entered, but this was at the point prior to entry, this was the lowest low of the pullback meaning the sell-off. And this was a low, this one was equal to or lower than, but this was the lowest low. So we'll place our stop just below here. This can be 1 tick, it can be a point. It's totally up to you. This is where your discretion comes in on your 25 or 30% discretion on a strategy. Okay, this is where your insight comes in and makes you a part of the process. But we teach you what to look for in the courses. Okay, and then look what happened. You see how simple it was? We didn't rely on any chat room or trading room. We didn't look at any news. We weren't concerned about what an indicator said or what some guru was telling us on TV. We simply listened to the most important thing, and that was the chart in front of us, the market. That's how simple trading can be, and that's how you get on that road to consistency. If you're brave enough to strip away all the things that conventional wisdom has told us that will make us successful, and then ask yourself, well, if it's supposed to make me successful, how have I been doing so far? And if you're not happy with it, well, it's not working. So strip it away and make your trading as simple as possible. All we did was we found the trend because price was above. We looked for a particular bar that was telling us that we're most likely going higher. Why? Because it closed in its top 25%. And then we just jumped on board when it traded above that. That's it. Okay? Now, where we exit and how we trail this particular trade, 2 specific things we cannot share with you. I know a lot of you are saying like, well, Steve, where do I get out? Once again, save that question. You can just wipe that, scratch out that question. I'm not going to tell you because that comes with the course, and it wouldn't be fair to the people who have paid thousands of dollars for this course, who do very well, but it wouldn't be fair for me just all of a sudden just to give away everything. But I share with you probably the basic guidelines of this strategy, the first 4 rules. All right, let's show you some recent examples, and let's put it all together. Let's say we have a $50,000 trading account, okay? Just a hypothetical $50,000 trading account. We look here, looking back this past month, all right? We ask ourselves, where is price in relation to the 50-period simple moving average? Well, the price is above. It's pulled back what's above. And guess what? Here is a bar that closed in the top 25% of its range. And our add-on here generated a buy signal. Okay, so this is a valid setup to go long strategy. Number 4, go long the E-mini on a daily bar basis. So our entry would be roughly at 1876, and our stop would be just below the lowest low would be 1859. Remember, these are daily bars, and these are for people who are trading the E-mini overnight. So I assume you would have a large enough account size. Okay, and this, by the way, this signal was made privy to all of our members of Specialist Trading. So you would enter there, but we have to calculate the RPS method. So if we got stopped out right off the bat, we would lose 17 points. So let's figure the RPS method out. We have a $50,000 trading account. 2% of that equals $1,000. Okay? P, or the point dollar loss, would come out to $850. So because 17 points per contract comes out to $850. So if we divide R by P, 1,000 by 850, we round it off, that gives us 1. So we could trade 1 contract. And I took this snapshot yesterday, but I'm sure anyone looking at the markets today knows that the market went even higher today. So this is how well strategy number 1 works in any market, in any time frame. So let's go to a smaller time frame. This was on 6/3. If you look down here at the date, this was a 5-minute chart in the E-mini, and this was from Tuesday. Now, the majority of price on the opening of this 5-minute bar was below the 50-period simple moving average. So this means we're looking to go short. And our automatic add-on generated a sell signal here, as this red arrow is showing you. But please remember, once again, after you take the course and after you've asked me questions and studied with me, there's no reason to really rely on the add-on because you'll know how to spot a signal automatically yourself. But these are great learning tools in the beginning, so that's why we provide you with them. So let's figure out the RPS method. We would enter short at 1920.75, and we would place our stop at 1922.50. So based on a $15,000 trading account, R equals, or first of all, we have to see what our stop losses. That's 1 3/4 points if we were stopped out. So R would equal 300 because that's 2% of 15,000. P would equal 87.50. That's how much we'd lose per contract if we were stopped out. So we simply divide R by P, 300 by 87.50. That gives us 3. So we could go short 3 contracts, and we had a nice trade there. This was on Tuesday in a 5-minute chart. Now let's look at some other recent strategy examples in other markets, but let's start out with something that happened today, in fact this morning. If you were a member of Specialist Trading and you had the strategy number 4 course, you would have been prompted by the add-on you see here, or just watching it on your own, you would have known that at 7:30 Pacific time there was a buy signal on a 15-minute chart to go long the E-mini. Now remember, this was before this huge gain we had today. This was at 7:30 this morning. Okay, Pacific time. So the market was only open for 1 hour. We had a buy signal. So you would have entered right here roughly about 1928 and placed your stop roughly about 1921. And look what happened. We all know what happened in the market after that. In the first hour, hour and a half, you would have made nearly 12 points. Okay, so this shows you, the validity of this particular strategy. We're not just showing you charts that are 2 years old, like many educators do in their presentations. This happened a matter of hours ago, this morning. How about GIS? This is a daily chart. First thing we ask ourselves is, where is price in relation to the 50-period simple moving average? Well, a couple of weeks ago, we had price above, and we still are above, and we were automatically generating a buy signal to go long. We closed in the top 25%. We're above the 50-period simple moving average. Now, I know a lot of you would say, well, Steve, this closed in the top 25%. Why didn't this generate? Well, because we never traded above. You see how that? We have to trade above in order to go long. By the fact that we didn't trade above, it's telling us that there is not enough momentum. That's why we don't want to enter. So had we just simply entered at the market the way most traders enter, look what would have happened. We would have lost a good point and most likely have been stopped out. We want to enter as soon as the train leaves the station in our direction. So we want to see that price trades above right here on the very next bar. That's our confirmation that most likely we're continuing in the same direction. So here's where our entry would have been, and here's where we placed our stop, just below the lowest low of the pullback. And you could have entered roughly about 53.5 and made a couple of points in the next week. Okay. And then finally, for you currency traders, for Forex traders, we see here the euro dollar going back to the middle of May, just a couple of weeks ago. We see here that we automatically were generating a sell signal in the euro dollar right here to go short. Now, here's where things get a little bit touchy. Most advanced traders know this, but we teach this in the course. I know traders right off the bat will say, well, Steve, wait a minute, you said price has to be below. I see here that the majority of price is above. That is true. But as I stated, the main thing is we want to make sure we enter. Our entry would be right here, 1 tick below. So as long as your entry is below the 50, it's still a valid, although advanced way of trading this. We don't suggest that each trader trade this way, but this is an advanced way to trade, even if the majority of prices are on the opposite side, as long as your entry is in sync. So this was a valid signal that was generated to go short the euro dollar. You would have entered 1 pip below and had a large stop placement right up here because this was at the very top. But if you had enough money in your account and or even if you wanted to trade things such as options or the mini account, you could do that with this particular trade. And look what happened. So you see how it doesn't matter what market or what direction, these simple edges and techniques I'm sharing with you today work in any market, any direction. Why? Because you're listening to the market. They're designed to tell you what the market wants to do. In other words, the market is always giving us clues. It's always telling us, what it wants to do or where it's most likely going. It gives us a high probability. It's just our job to jump on board and follow it. It's not our job to try and outguess whatever market we're trading by picking tops and bottoms. It's not going to work. Ultimately, it may work 5 or 6 times, but on that next try, you're going to give everything back. So remember, our credo is consistency, and there's no consistency in that type of trading where you're picking tops and bottoms. And I know this, once again, firsthand because this is the way I used to originally trade. And I didn't make a dime my first 2 years as a specialist. So it wasn't until I started listening to these things, which my mentors taught me, that I started to get on that road to consistency. All right, so let's review. Secret number 3 in our money management course is all about position sizing. Make sure your trading is adequately capitalized, okay? You're only going to risk on average 2% of whatever your capital is. Once you do that, you want to apply the RPS method, a simple mathematical formula that must be used prior to every trade. But you can't be in a trade and then figure out what you're going to use, how many contracts. You have to do this before. And with enough practice, you'll be able to do it automatically. The beauty of the RPS method is that it automatically decides how many shares or lots to trade. So it takes the guesswork out of position sizing. Okay? And then if we want to review strategy number 4, it's based on concepts 1 and 2. Concept 1 being that we always trade in sync with the trend. Concept 2 is we buy on pullbacks or consolidation within the trend. Obviously the reverse for going short. It's designed to trade quick momentum moves, but we also teach you in the course advanced techniques to stay in the trade longer if you like. Intensity level between 1 and 3 is a 2, very moderate. Only one indicator, the buy-sell line or the 50-period simple moving average. The beauty of strategy 4, as I just showed you, it works in any time frame, any direction, in any market. But please learn the full strategy first. I just gave you 4 rules. You can do very well with the 4 rules I just gave you. They will heighten your chances for success. But if you want to really trade this strategy with consistency, you must become a member and get all of the rules, okay? So ask yourself, before we conclude here for questions and answers, would one of these edges, I just gave you a ton of these edges, the RPS method, I shared with you about the 50-period simple moving average, price closing in the top 25%, or bottom 25% to go short. Would any of these things help your trading this past year? Even if you just wanted to take one of them as a golden nugget just to use to heighten your chances for success. What if you could get more edges? What if I could provide you with, let's say, 10, 20, even 30 more edges to increase your trading results? If I could just take a few moments here to talk about a special 2-for-1 attendee special we have. We have 2 very, very important courses here. One is the 7 Secrets of Money Management course. Okay, the RPS method is included in that course. It's extremely powerful because I teach you a ton of money management techniques, and then we're offering it with a combo with the E-mini strategy number 4, which can be used in virtually any market, as I just shared with you. All the examples I just showed with stocks, with the currency pairs, and with the E-mini can be used with the E-mini strategy number 4. And this is part of our stock, or I should say E-mini college. We have stock colleges, stock courses, which come with upwards of 10 different strategies. We have E-mini courses, and we also have Forex courses. Strategy number 4 works in all of those particular courses as well. Now, if you're wondering what's in the money management, you have instant course access. This comes with 8 total videos of money management things, just as the RPS method that I shared with you. It comes with 6 different stop placement techniques. These are all proprietary stop placement techniques. It comes with the RPS method, but different ways in which to use it, because I just shared with you the E-mini formula. There's also a stock and a Forex formula for using the RPS method. It comes with different risk-reward ratios. In fact, 2 of the videos are dedicated to risk-reward ratio. There's also a video that deals with trailing stops. And then lastly, the most important video is the ATM, or Advanced Trade Management. This is a great technique designed to keep you out of drawdowns. So this is all included in the 7 Secrets of Money Management course. Now, if you're interested in combining that with a great strategy, well, this combo includes strategy number 4, which we just shared with you. Instant course access, detailed instruction, 5 more videos, online videos. We share with you all the different entry, exit, and stop techniques. Signal alerts, you show that add-on with a little arrow will appear, an up arrow or down arrow for buy and sell signals. Weekly video trading lessons that have been archived so you can increase your chances for success. Remember, this comes with a free buy and sell add-on, so you'll know exactly when a signal is generated, either if you're trading 5-minute charts of the stock market, or if you're trading monthly charts of the Forex markets. And then access to my personal email if you have any questions. So these are both important pieces of the puzzle. They're both included in different courses, such as the stock course or such as the E-mini course. But we've taken these 2 real important pieces of the puzzle and offered them to you for a 2-for-1 attendee special. These would normally cost you upwards of $3,000. We've discounted the price down to $1,495. That's a total of 13 videos altogether, all the 7 Secrets of Money Management course, as well as all the rules and the add-on to strategy number 4 with my personal email address as well. This normally would cost you if you bought them individually without the discount over $3,000. Actually, we've discounted it at $14.95, and we understand that that still may be a little bit too difficult for some people to meet. So we will have payment plans available for a limited time if you'd like to pay on a monthly basis, and our trading consultants will work with you. So here's the information. If you're interested to take advantage of this limited offer, contact our trading consultants at trading@protraderstrategies.com, or you can call us directly at 598-6677. Now, the last 10 minutes or so we have here, I want to make sure that I've answered the question. So I want to thank you all for waiting. Let me just get here real quickly and open up the question and answer box. And I see some people are still asking if this is being recorded. Yes, it is. You can contact us, as you see right here above, either email or contact one of our trading consultants at the phone number provided, and we will set you up. Okay? Let me see here. I'll try to go at the beginning. Anthony asks, how about a $2,000 trading account? Well, Anthony, you know, I feel personally, if you're, I assume this is for intraday trading, Anthony. If you're intraday trading, I think the bare minimum should be $5,000. $2,000 is probably a little bit too much. You can still use this. I would suggest using the RPS method, but risk no more than 3% because you're not going to give yourself a lot of room there for stop placement. I think if you're going to trade intraday, you should have a minimum of 5,000. Better would be 10 to 15,000. Okay, so it just makes it a little bit difficult to be trading with that. Okay. Peter asked, does this work on a daily chart? Yes, it does. I showed you a bunch of examples later on. I know in the beginning I was showing an intraday chart, but it doesn't matter what time frame. It doesn't matter. All that matters is you fill in the parameters. So both strategy 4 as well as the RPS method work on any time frame in any market. The only thing I did not share with you is I showed you the rules for trading the E-mini with the RPS method. There are different rules for trading stocks as well as the Forex. So this is all included in the course. Okay. Let's see, John asks, if trading a stock, what would be a tick that would trigger entry 5 to 30 cents? Okay, John, that's a good example. I would say it doesn't have to be that big. I would say a tick could be anywhere from 1 tick to 10 or 15, okay? If it goes above 15 ticks, most likely, you know, you may have lost a lot of the momentum already because many times you'd be entering and maybe we teach you ways in which to move your stop to unchanged, and possibly you would be entering at a level where you may want to already move your stop to a certain level. So I would say anywhere from 1 to 15 cents would be okay to use for a confirmation. Bill asks, will we be able to get a recording? Yes, you will, Bill. Just contact the information provided in front of you, and you'll be able to get a link. Peter says, 5 days ago you had a buy signal. I'm sure we did, Peter. I'm not sure what market you're talking about. If you could fill me in on the market. But does it work with low volume stocks like below the 50,000 on a day? Yes, it does, Peter. In fact, we don't look at volume in anything because volume, once again, is too subjective, and we're not concerned with that. We're only looking at what the market is telling us. I know a lot of people rely on volume, and I know there are some members we have that will only you know, watch for volume, and that's fine if that works for you, but we don't want to say that it's something that we're requiring. In fact, none of our strategies require volume at all. So it's up to you. We see this working. Strategy number 4 works. We've seen it on $4 and $5 stocks. We've seen it work on you know, Apple and $500 and $700 stocks. So it really doesn't matter. Okay. Let me see. What happens if you miss the first buy or sell signal? Well, you know, it's like that old phrase, you know, you miss one, there's another one along in 5 minutes. It all depends on which version or which market I should be you're talking about. If you are, let's say, looking at a 5-minute chart, you're going to get a number of signals, and let's say you're also looking at a tick chart. You're going to get a lot of setups using strategy number 4. But if you're looking at a daily bar chart, well, if you're only tracking one stock or one market, you may have to wait another couple of days for another setup. That's why we say if you're looking at daily bars or time frames such as that, then you know, look at a number of markets because you may not get into one, but you may get into another. But this is all part of the course, and we teach you how to do this. Alan asks, do your studies you discussed during the course available on TOS? That's Thinkorswim. That's something you'd have to contact our trading consultants. I believe we have some of the methods that work for Thinkorswim, but there's a special process, so we just have to make sure. I would contact any one of our trading consultants and see, but I'm pretty sure it does. Okay. John asks, is that signal the PET-D? John, I'm not sure what signal you're referring to. The PET-D is a totally different program. The PET-D is a short-term trend identifier, and today we were talking about money management as well as a full-fledged strategy. So the PET-D is something totally different. So I see we have a couple of questions about Thinkorswim. I would contact and see and talk to one of our trading consultants, because I'm pretty sure it will work with Thinkorswim. Let's see, Bill's still asking about the recording. Yes, this has been recorded. Bulos is asking, what about the exit? Remember, once again, I said, when I was showing, I said, I know a lot of you are going to say, where's the exit? And unfortunately, I can't give that to you because that is proprietary and that comes with the course. So if I gave you the exit, I might as well just give you $1,000 for free and say, here, go ahead and take it, because that's usually the price of the course. And this is something that comes with our teaching and mentoring. So we want you to become members so you can get all of the information and learn and grow with us, as opposed to me just blindly giving you the rules and hope that you understand the process behind it, okay? Let's see here. Steve asks, do you wait for price to get to or near the 50 moving average before you start looking for a strategy number 4 trade? And does it matter how far the 25% bar is away from the 50 line before you enter into the trade? Those are good questions, Steve. Ideally, this is just an ideal scenario. You want to see, if you're going long, all the bars above the 50 period. And if you're going short, you want to see all of the bars below the 50 period. Now, we have some students that like to take trades that are close to the 50 because they feel that this is some type of a pullback and price will touch, revert to the mean, and then progress in the direction you want it to go. So this is all, once again, something that comes with the course and comes with my mentoring and sharing what you're looking for, and then having you become part of the process. Strategy number 4 will work if it's away from the 50 or if it's close to the 50. It all depends what type of trade you want to take and feel the most comfortable with. We have some students that only take trades that are close to the 50. We have others that say, no, I'd rather take a trade that's further away because this means there's more momentum. It all depends on what type of trader you are, okay? I think the last question you said is, does it matter how far the 25% bar is away from the 50? Once again, this is a discretionary part of the process that comes with you. Now, when we say discretionary, we're not talking about what I stated in the beginning where you're taking yourself out of the game. This type of discretion is fine and what we encourage. This is an insight that you get by becoming a part of the process. So all of what I teach and trade are strategies, and strategies are 70% rule-based, but we allot you 30% for discretion. And discretion is that process that you become. In other words, you say, well, you know what, I trade strategy 4, but I trade it a little bit different, meaning that I only trade strategy 4 that touches the 50 periods of moving average line. Those are the only trades I want to take. Whereas someone else would say, no, I trade each and all strategy number 4 setups. It doesn't matter. That's part of the process. That's what we want you to discover through our mentorship at Specialist Trading, okay? Seb asks, how long is the offer on? I believe it's on for just the next couple of days, Seb. So if you really want to take advantage of that, remember, we have payment plans. So I realize $14.95 may be a bit too much, but trust me, you can make that a minimum payment each and every month so that you can be learning all this information quickly and get it already online, okay? Dennis says, I thought I saw you teach that on a different webinar with an inside bar in the top or bottom 25%. No, Dennis, I think that was, you're talking about the PET-D, and that's a totally different thing. We're looking for a momentum move, but that has nothing to do with strategy number 4, okay? That was something totally different. Hamath asks, hi, Kumar. He says, sometimes this type of trade will become hit or stop. If I used PET-D, can I reduce this trade loss because within 2 days I already to purchase that product? Oh yeah, well, remember, discuss this with your trading consultant, but yeah, that's a totally different product. The PET-D is a great short-term tool that will increase your odds even more. But we're not talking about that today. They would have to tell you how you can get that with any type of a discount. But yes, that will increase your odds. The PET-D is just a short-term tool, which is a color bar system, which tells you what the short-term trend is. And so it will tell you when an opportune time is to buy based on strategy number 4 and when an opportune time is to stay out of the market. But once again, that's a totally different webinar, and we'll reserve that for a different time. But you can discuss that with your trading consultant. Peter says low volume stocks could be manipulated. No, Peter, once again, we're not concerned with that. We don't concern ourselves other with what we see on the chart. I used to trade this way myself, so I'm not trying to be arrogant or condescending. I used to worry about that. I used to worry about what market makers were doing in New York until my mentor said, Steve, don't worry about that. Just trade what you see in front of you. Don't make trading more complicated than it is. Worrying about, where, how much slippage you should be getting, and if you got screwed out of certain stops, or if they're running the stops, or if someone's manipulating the volume. We're not concerned with that. Just trade the hand you're dealt, okay? And we'll see that you get that level of consistency when you try to uncomplicate your trading, worrying about manipulation going on, okay? So we really don't care about that. Eugene asks, do you also use the RSI? Well, the RSI is a great tool that we use for totally different purposes, and we have a proprietary setting for it, but we don't use it in this. No, this has nothing to do with the RSI, okay? Eugene asks, how many transactions are manageable? Once again, it depends on the trader. I know some traders who can trade 30, 40 times a day, and they're totally at ease. They can manage everything. I know other traders, such as myself, who only like to trade 2 or 3 times a day at most. Anything more than that is unmanageable. So that's discretionary. It's totally up to you. But once you figure out the entire rules and come under our courses and our mentorship, you can decide for yourself what's manageable. That's a discretionary question. Ken asks, on Forex, can you trade it around the clock, or the strategy might be used at a specific time? No, Ken, you can trade it around the clock. All you're looking for is that particular setup, okay? It really doesn't matter. Now, you may see times when the momentum is better. You may get some choppier times, but that all comes with, once again, becoming a part of the process and seeing what works best for you. We have people that trade at 20. Our strategy, this strategy is traded in over 60 countries, I believe, or close to 60 countries, traded by hedge fund managers and people that have been trading for a couple of weeks. And so, obviously, they can't trade, New York or United States hours all the time, so they're trading it in overnight hours as well. So it trades just about any market, any time frame. Let's see, Steve asks, do you wait for price to go near or the 50 line before you start looking? I think that was the same one you asked before, Steve. I'm sorry, I just answered that. King asks, could I repeat the 25% entry again and again in the trend? Scaling in other words. That's a good question, King. We really don't suggest about scaling in. We show ways in which to do it if you'd like to scale in, but it's really not part of the course. We're more just, once again, as we stated, cut and dry. We just like to get in and get out. We show you different ways of where to get in, different ways of which to get out. I suppose you could use this. You could continue to keep using that technique. We could follow up on this in the course, but this is not something we really do. I don't like to scale into a lot of trades, but we have videos that talk about that as well, though. John asks, if you were an option trader on stocks and ETFs, what course would be the best for us? Well, John, pretty much any course, because the way we suggest to our option traders is to go to further out of a time frame. In other words, we know that most option traders aren't just going to trade for a couple of days, but many of our strategies hit their target levels in a couple of days and you're out. So that may not be the best thing for an option trader. So what we suggest is you can do 2 things. You can either trade the options that expire in a couple of days, I believe they're weekly options, and you can use those and they work perfectly with our strategies. Or if you just want to trade the longer, trade options for 2 to 3 weeks or a month, you can just look at weekly charts and you'll see the same exact signals on a weekly chart, and you just take them and apply the options either by calls or by puts. We don't have option courses per se. In other words, we don't hedge with with a lot of options. We don't use those techniques. We don't use a lot of different scenarios with that. We would simply suggest our members to buy calls or buy put options based on the signal. Last few questions here. Can I ask, is your 50 the EMA or the SMA? It's the SMA, the simple moving average. But remember, it's not something magical. The main thing we really want to stress is that it's okay to use an exponential moving average as opposed to a simple. The main thing is that you want to trade in sync with the trend. If the majority of price is above the moving average, then you only want to be looking for long setups. If the majority of price is below, you only want to be looking for sell setups. It's that simple. In fact, I want each and every one of you to go back and look at your last 10, 20 trades, and most specifically, look at your losing trades. I can almost guarantee that the reason you lost is because you went long when price was below, your entry was below the 50, and you went short when your entry was above the 50, okay? And trust me, it's a numbers game. We're looking for consistency, and the way you get that is by trading in sync with the overall trend. So our best way to trade with the overall trend is by simply using that 50-period moving average. Now, the short-term trend is what the PET-D is. That's a totally different webinar, and that's how we know the very short, minute trend. But the overall trend is simply buying above the 50 and looking to go short below the 50, okay? Never confuse the two. In the long run, it will really help you become consistent. This is the one thing that turned my way of trading around tremendously. In fact, if I were stuck on a desert island, I only had one tool to use in my trading, it would be that. Regardless of any indicator, any pattern recognition strategy, it would be the 50 periods of moving average. Because I know over time that will sustain me. Okay? I know a lot of you are going to say, well, Steve, I had a great trade where I went short and price was way above the 50, or I went long and price was way below. Yes, you're going to see that from time to time. But remember, we're looking for consistency, and I can almost guarantee that that's a recipe for disaster, because over time, it's not going to work. You're going to have one or two trades where you're going to get killed, and that's not the way we want our trading to be. You don't want to be trading for 2 to 3 years and then be wiped out. You want to be trading 10, 20, 30 years down the road. Okay? Lastly, I'm going to take this last question. Majority meaning what time frame? Well, when you say majority, I don't understand what context you mean by majority. If I said majority, I was saying it in context with the majority of traders. But this can be it doesn't matter what time frame you use either of these methods. Okay? It could be a 5-minute time frame. It could be a weekly or a monthly. It doesn't matter. Just the majority of traders are having a difficult time regardless of time frame because they're out of sync with these simple rules. But the majority of the time, if you're asking about the 50-period simple moving average, you just want to see that if you're looking at, going back, let's say on a monthly time frame, looking at daily bars going back a month, you just want to see the majority of bars. Let's say that 2/3 of them are above the 50 period, and 2/3 are below if you're looking to go short. Okay. And once again, this comes with becoming a part of the process. We don't want you ultimately not to be able to figure this out on your own. After you take my courses, after you become part of our courses and become a student, you'll be able to know and say, you know what, I know what to look for now because I've empowered myself so that I can rely on my own trading. I don't have to rely on some guy giving me signals each and every night that I really don't know what they're based off of, or I don't have to rely on some trading room telling me what to do or some chat room. I can see everything for myself, and I trust myself that I know I'm consistent. That's what we're trying to teach you, okay? So if you're interested in coming on board with this great discount, remember we have payment plans, take advantage of that in the next couple of days, and I look forward to teaching all of you and having all of you become members of my courses, okay? Remember, we have courses and stock trading courses, we have e-mini courses, we have Forex courses. I've just shared with you 2 great pieces of the puzzle that are part of those courses that you can have for a really discounted price, okay? Thank you so much. I look forward to trading with all of you and having you all become my students, and I shall see you next time. Bye-bye.